Hey everyone, we are live with Robert Kientz of Gold Silver Pros. I'm your host, Elijah K. Johnson with Liberty and Finance. Again, we are live with Robert Kientz of Gold Silver Pros. Robert, thank you so much for joining us today.
Thanks for having me, Elijah.
Definitely. Kind of a crazy couple days in the metals markets when we saw this announcement from the Fed that they were going to move forward the time that they're thinking about raising rates. Metals just sold off, and now today alone we're seeing silver down about 5% and gold about 2.5%. Gold is below the 1800 level, and silver made it all the way below $26. Your perspective on what we're seeing in the metals markets right now?
There's a huge sell-off, and we were talking about this prior to the show, looking at the volume numbers. There's a huge rotation out of the predominantly active contract month in silver of July into later in the year in September and some in December. So September and December added together are actually bigger than July. And yesterday, I think Wednesday, we lost 4,300 contracts at 5,000 ounce silver. So a lot of selling, and this is kind of early in the month to do that. We're only in the 17th day of the month. There's this theory out there that gets propagated about the basis of the trade in gold and silver, that as you get closer to the end of the month, you're going to have people rolling to new months, and that would have price pressure, which is true. But I would make the point that when you're unwinding a derivative contract, you're unwinding both a short and long at the same time. And so it's not just the fact that you're rolling to a new month, it's what the relative positions are going to be. It's very early in the month to see this much rotation out of silver. Gold hasn't had that much rotation. It is rolling. The active contract month right now is August. It's rolling somewhat to December, but not nearly as much as in silver. So I think they're different stories. The same thing I see on the COMEX data for gold and silver is that we have settlements wildly lower over the last 2 days, but especially today. So I'm going to go to silver first. Yesterday, the majority of the settlements closed at $27.81. We're now sitting at under a $26 silver price. That's almost a $2 move in settlements on COMEX in 1 day, from yesterday to whatever the final numbers are going to be today. That's astounding. That very, very rarely occurs. And again, it doesn't match up with the rollover. We're not having as much. We're having rollover, but in the middle of the month, I mean, this is an abnormal pattern. This is not typically what you see on COMEX. If I go to the gold volume data, and by the way, volume is up in both gold and silver, which means there's more short pressure on the contracts to begin with. So there's more people coming in, initiating short positions. But if we look at the settlements in gold, yesterday, the average settlement for August contract was 1861.40. Well, we're sitting at like a 1771, 1772 gold price. That's a huge difference. So essentially what's happening is we're in the middle of the month. We shouldn't see as much roll as we're seeing in silver. We're not seeing that much roll in gold. So it has nothing to do with that basis, co-basis argument that some commentators make. That doesn't explain this. When you have this in the middle of the month, what it is people hitting the futures with a ton of short interest. That is the only thing it could be. And what is the driver of that? You mentioned the Fed. The Fed may bring forward their interest rate hikes. Okay, fine. That should be bullish for gold and silver, because what happened the last time the Fed hiked rates? We had a 20% negative correction in the stock market. I believe that was Q4 of 2018. That backfired on the Fed. And so they then had to ease. So when you have a market addicted to low interest rate debt and you threaten to raise rates, that is usually a sign the economy is going to slow down. There's less debt available. The stock market's going to correct when that actually occurs. So why wouldn't that be bullish for gold and silver? So nothing in the physical mechanics of the markets explain what's going on in gold and silver, other than the fact, in terms of contract rollover, it's more of the fact in the middle of the month they're getting slammed with short paper. It's blatantly obvious on the charts. And there's nothing about what the Fed said that should be extremely bearish for gold and silver. It makes no sense. It's a contrary, the market is acting contrary to the way it's always acted. And the only way that it acts contrary to the way that the market usually acts is you have big players coordinating for that to occur. Because the rest of the market on a pending rate hike is not going to slam gold and silver. They're not going to exit their gold and silver positions or sell short paper on the COMEX. It just doesn't make any sense.
Now, kind of to that point, now, just to remind our viewers who are just getting in. We're with Robert Kientz of Gold Silver Pros. We're seeing as we speak gold and silver plummeting. They're down. Silver's down about 5% today. Gold's down around 2.5%. This is the continuation of the sell-off we saw yesterday, and people are actually commenting in the comments that the title of this video, "Sell-off in metals," might be a bit misplaced, because as you're saying, it's like, well, what is actually happening? Are people actually selling metals, or is this just manipulation? And if people are interested in learning more about the manipulation debate, we have a link in the description of this video to kind of get all perspectives on that. But I would like to get your perspective on this, because we've been seeing really throughout the last couple, this year and last year as well, when we've seen extreme demand for physical metal on the retail side, like at Miles Franklin. Andy Scheckman points this out so much that we're not seeing people selling. We're not seeing almost no people selling, but we see this, dramatic decrease in the price. So your perspective on what is really going on? People aren't really selling the metal, are they?
No, I mean, if you look on so let's start at the COMEX. If you look on the COMEX, June has been a big delivery month. I'm looking at the year-to-date delivery notices from NYMEX right now, and it's 22,229 contracts, which is the fourth most delivery this year on a monthly contract, and we're only slightly over halfway through. So we could get to the 30,000 number in terms of delivered contracts. Now, silver, not quite as many deliveries, but gold has had very robust deliveries. And then, like you said, if you look at the retail numbers, we're having shortages of available gold and silver, which is why we have the premiums. So I don't think people are selling their physical gold and silver, definitely not the retail crowd. And they're taking gold at least off of the derivatives market. So again, I don't think a physical dumping of gold and silver to this market really is the explanation. And when you understand how spot price is determined, we know that for a fact, because spot price is determined by the derivative markets. It's the collaboration of the London OTC market and the COMEX. And the reason I say that is because the COMEX very closely mirrors the quote unquote spot price that you see. And we've seen all this collaboration between the London market and the US market. So we know that they collaborate on products. They have the EFP mechanism, they have the 400-ounce bar mechanism. And so the markets closely follow each other. So spot is determined by the derivative market, not physical selling. But if you read the financial news, they'll say gold is selling off, silver is selling off, and people don't know the difference between the physical and the derivatives complex. I think people that follow your channel know the difference, but that's a big part of what we do, is to educate people as to how spots actually determine, and the mechanics of the price rises and falls are more determined by the derivatives. Now, a big delivery month on COMEX can cause interest in the metals to increase, and that will be reflected in the derivatives, but that's usually an after effect. But when you see a sell-off like this, it very rarely ever has anything to do with the actual physical movement of the metals in the market.
I think that's such a good point, and that's kind of what I was referring to, is the physical selling for the retail side, that we're not seeing a lot of that. Now, with respect to you mentioned the interest rates, right? How the Fed has been saying, well, we might raise interest rates far in the future, but they kind of brought that time horizon forward a bit. Mm-hmm. Now, you said that should actually be bullish for precious metals. A lot of people argue that gold especially is negatively correlated with real interest rates. So, and that's like the greatest correlation there that you could possibly have. So yes, it seems like it would actually be bearish in that argument if you go by real interest rates. But your perspective on that?
It is typically. So if you chart, the biggest predictor of gold price is going to be real interest rates. And that is the interest rate, minus basically the value, I'll say the value of money. So if you get negative interest rates, if you get a negative net return on your money, yes, it is over the long term. However, in the short term, people take other factors into account. They take into account the health of the economy, what the interest rate's going to do to the bond complex, what the interest rate's going to do to corporate America. And especially, we have to be careful, Elijah, looking back at 30 and 40-year-old data to now, because we're at a different stage of the life cycle of the US dollar and the debt system. where you have rising rates with this much debt outstanding, record levels of corporate debt, record levels of personal debt, record levels of government debt, rising interest rates are a threat to the solvency of that entire system. And the longer term, that should be bullish for gold and silver. And a lot of analysts understand this. So could some of the selling pressure in the derivative markets be because of the inverse correlation of gold price to interest to expected interest rates? Sure, but not to this amount. I don't think it is. And people who understand the or have questions about the solvency of the debt-based system and what a rising interest rate could do to that, I think, when you have that longer term view, you have to look at this as, buying opportunity if you're in gold and silver, because I don't, unless this is a coordinated action to tamp down the gold and silver price, I don't see this lasting. I don't see this price drop lasting, because people are going to start figuring out, wait, if we raise bond rates, what if the 10-year bond rate, rises half a point eventually? What if mortgage rates rise from record lows and we start getting 4, 5, 6, 7%? What's that going to cause to housing prices? Housing prices have to fall. Okay, housing prices are inversely correlated to the cost of servicing the loan. Then you have to look at the federal government. If you raise interest rates, the cost of that debt gets exceedingly expensive. And how do you pay for it? You have to take on more debt because it's not in the budget. We're running a potential $6 trillion deficit. That's what the Biden administration wants to run, a $6 trillion budget deficit. So where are you going to get the money to pay extra interest costs on the US debt? You don't have it. You're going to have to borrow more. See, we're now in a point in which that system is not going to work anymore. So yes, negative interest rates are negatively correlated with gold price, but you have to take it in context of where you are in the economic cycle and what we've seen in the past. And so if gold and silver price keep falling like this, then it has to be some sort of manipulation, because especially bondholders are very wise and they understand the impact of interest rates. And the market traders are going to consider the long-term implications. That's what I would say. When you're looking at derivatives markets, you're looking at people with a lot of financial information. This isn't the retail trader. When you're looking at the derivative markets, this is the big wealthy family houses. This is the hedge funds. These are the bullion banks. These are not stupid people.
No, kind of getting into that with respect to, we're seeing the prices fall. And for those just joining right now, we're seeing gold down about 2.5% today, silver down 5%. It's below $26 today, and gold is below $1,800. So kind of your perspective, does this change the long-term bullish trend for gold and silver?
No, not really, because when you looked at gold, the most prevalent pattern from 2011 was a cup and handle, and I've said it could retrace all the way to high 1600s and still be within that bullish formation, and we never got down to high 1600s after the last high in gold last year. So it's still within a bullish pattern. But also, if you look at the fundamentals, the derivative markets can drive gold down to whatever they want in the short term, but the fundamentals eventually are going to overtake it. In silver, it's such in demand industrially, it's beneficial for the economy to keep a lower price until you don't have any silver left. And then all of a sudden that has to snap back. And we're getting close to a point in which there's not enough available silver at this price. Yes, there are hundreds of millions of ounces stored in investors' hands, within the derivatives complex itself, within the depositories and in private hands. But to get that silver out, you're going to have a much higher silver price. See, that's the way that works. It's supply and demand and price. People aren't going to give up that silver at $26, $27. They're going to hold it. So the long-term factors in gold and silver are both bullish. So I've stopped worrying too much about short-term price movements, other than in situations like this where it seems counterintuitive. I really look more at the long-term supply-demand fundamentals, and then I look at the economy, and that's what drives my decisions. And so I'm not going to plan on selling any of my gold and silver. I'm going to hold it, because I think the ultimate value of gold and silver, when we get to that ultimate value case, they're at a much higher price level. And I don't think that that's 10 years from now. I think it's a lot closer than that.
I think that's such a good point, how really to look at the long-term horizon for gold, and the fundamentals still seem very bullish. One of the things that people are commenting in the comments here, and yeah, to our viewers, everyone watching, if you do have any questions for Robert you'd like me to ask, just type them in the comment section right there, the feed you see. Now, with respect to one of the fundamentals for gold, Basel III, there's some questions on that. Your perspective on how that will impact gold and possibly silver going forward.
So what I have said about Basel III is there's been a wide range of commentary. So I've had different people on my program. Andrew McGuire came on our program. We premiered that last night, and he thinks Basel III will forever alter the landscape of gold because he says, Robert, you can't unwind all the derivative unallocated positions in the London market without consequences. True, there are 4 big banks there that trade that could have consequences to those banks. There could be big losses. How that affects the COMEX. COMEX is a different market. We've seen a report by the OCC that they're already in compliance with Basel III from the gold end. So, and we haven't seen, a big movement there. On the other hand, I had David Morgan on my show last week, and he said, well, I've talked to people in the gold industry. They don't think it's going to have much of an effect because he thinks that people have prepared for that. And they have done what they needed to do. They've already, taken the other side of that or unwound their positions. Whether that's true or not, we're going to see. I've landed somewhere in the middle because the way that I look at it is, to me, it's not just the requirement that to consider gold as a high quality asset on your books, it has to be real gold allocated and hedged, which is what Basel III requires. So unallocated doesn't count there. It's not just that. It's the fact that we're seeing a change in regime about the way gold is valued in the financial system. And a lot of these, what I call unallocated or derivative products, are going to have less value in terms of banking liquidity and the value of a banking asset. And not only that, but I think some of the gold trade is going to come out of London. So the second order effect is, where does that gold trade move? If the unallocated market, if the banks have to exit it, where does that go? Does it come to the US? Does it go to Shanghai? So in the short term, bullish of gold and silver for those reasons, because it's going to be more about the real gold than it is the derivatives. But eventually that trading moves somewhere. That's the second order longer term effect. Where does that trade move? Who absorbs that trade? Who becomes the power center in gold? And that's probably the bigger question long term. Who controls the gold? Right now, it's a collusion between the LBMA and the US markets. Who's going to determine gold price in the future? That's, to me, a very, very big question that nobody has really sought to answer in the gold community. I keep asking and nobody's providing me an answer, but to me, that's the big picture. What happens? Who controls the gold price? And therefore, are we going to go back to a multipolar market with many small markets where we're actually trading physical gold, or is another sort of derivative going to emerge? And if so, who controls that derivative?
Now, some people are saying that Basel III will really end the manipulation in the gold market. And like I said, if people would like to learn more about the whole debate surrounding whether gold and silver are manipulated, they can find a link in the description that gives a playlist with all the perspectives. But your perspective is that gold is manipulated. And I guess Basel III, will it end the manipulation in gold?
I don't think it's going to end the manipulation, because it's not going to take out all of the manipulated markets. And I don't think it's going to destroy all the manipulators. I think that the manipulation may move through different channels. I do think there's going to be adjustment there. And I think short term, that's why I'm bullish on all of the precious metals, gold, silver, platinum, palladium, because they're all traded in London, by the way. This isn't just about gold, it's about all 4. I do think I'm bullish on those metals for that reason, because to Andrew McGuire's point, and Alistair McLeod, who's been on this channel, yes, they've got to unwind all those positions, and that's going to have an effect. But I hesitate to think that the bankers, which developed the Basel regulations, are going to destroy their own balance sheets to let us have free gold. No, I think there's something else going on, and I think we have yet to see what they're going to do.
So moving forward, how do you think manipulation would play out after Basel III?
Well, definitely it's still going to be on the COMEX markets, because you can manipulate. You're looking at what's going on right now. You're looking at all the short paper being dumped on COMEX. It's blatantly obvious that there's a new additional paper at a lower price point to the tune of gold like $90 in a day and silver almost $2. That's a good way to do it. What happens to the London market, I think, is yet to be seen. I'm not one that thinks the OTC market completely goes away. I think it has a higher cost structure. It becomes less liquid, maybe less banking participants, but it's still going to be there and it's still going to serve a function. I do think the manipulative pressure will be eased for a while, and that will allow gold and silver to rise due to more physical demand and fundamental demand characteristics. But again, I'm not 100% convinced that the powers that be are going to let it run completely to, what some people call 10,000 gold and, $600 silver. I don't think that we're losing all of the manipulative factors that's going to happen. I do think that we're going to hit a new plateau, a new stair step, or a new bottom, if you will, on the gold and silver price. But again, I'm going to be watching these other markets to see what happens. What we in the Western world tend to focus on is the Western world. There's the rest of the world. There's billions of other people in other countries and billions of other, there are plenty of other markets in which would like to grab hold of that gold market. And there's going to be incentive for them to control it, because at the end of the day, gold is the ultimate asset in the financial system. To think that's ever going to be 100% allowed to trade freely would take a worldwide revolution from the people's perspective and understanding the value of gold. I don't think we're quite there yet. I think what we're going to see is more push for less derivative traded market pricing structure. But I don't think that people that have an incentive to control that price of gold and silver are going to let it completely run free. I do think that the gold market will be democratized to an extent. It's not going to as much be dominated by the Western powers as it has been.
Now, for those just joining us right now, we're with Robert Kientz of goldsilverpros.com, and we're seeing gold and silver sell off today, or fall, depending on whether you think it's real selling or not. Gold is below 1,800, silver is below $26. Now, this viewer is wanting to know, Leon is asking, gold or silver? So as we see gold and silver fall, silver is falling more. So it seems like a better buying opportunity for silver. Your perspective?
Yeah, I would say in the short term, more bullish on silver because it's used both industrially as an investment. I think we have extreme investment demand at the same time that the world needs a lot more ounces for industrial purposes. So from a fundamentals perspective, silver has the higher short-term upside, but silver tends to move after gold. So you probably see the gold price move first and then silver will follow. Traditionally, if we're going by traditional correlation between the gold and silver, gold will move first, silver will pick it up and it will move up more violently. Silver tends to be more speculative. So from the perspective of gold or silver, it depends upon your investment time horizon, your risk appetite and things like that. I can't make the decision for people. You have to make it for yourself. But the basic factors are silver moves after gold. Typically, it tends to move more violently, but it doesn't stay in one position for long. It can move violently to the upside. It can move violently to the downside. I would say from a fundamental perspective over the next few years, they both will continue to move up. There will be less volatility in gold, a little bit more safety from a price perspective, but there's higher gains to be had in silver. So it's really up to each person to decide what makes most sense for them in their investment portfolio. If we're going to a financial collapse scenario in which we think the whole house of cards of the financial market is going to collapse, like I wrote in my book, I do think it eventually is going to. That's the drop shadow. If we get to that point, then hey, pick one, because they're all going to go up. Things like farmland are going to go up. Any physical asset which has value, has traditionally been valued, is going to go up. And so you couldn't go wrong either way.
Sarge is wanting to know, why are countries repatriating their gold? And if you had any updates on kind of the latest revelations with respect to that.
Yes, countries are repatriating their gold because traditionally it's been stored in either London or New York, and we suspect, like I interviewed Nick Bereschiff, of the CEO of BMG Group, who runs a gold fund up in Canada, and he was looking at the authorized participant documents and all that stuff of when GLD and SLV first came out, and to give the brief version of this argument, he believes the central banks were leasing out their gold and it was going into things like GLD to give GLD liquidity. And he thinks they were, leasing out gold to other interested parties like the exchanges as well, to create a false sense of liquidity. Because if you report a certain amount of gold held on your balance sheet, but you're actually giving it to someone else, it creates a false sense that you still have all of that over here. So it inflates what people perceive as actual ounces available. So essentially, we have a situation which I think some people have figured that out. in Germany, Brazil, Hungary, and everybody wants to get their gold. I think they're realizing how much each ounce is rehypothecated or put into a paper contract. On top of that, many times what we actually have in gold and silver, and I think they're wanting to get it. If you look, Hugo Salinas Price, Mexican billionaire, recently wrote an article and said that his informants told him that China and Russia had threatened to peg their currencies to their gold holdings. And that's why some of the Basel regulations came about in the first place. In other words, he believes there was an incentive given by Russia and China to the Western gold markets to clean up their act. And if you look at what we suspect that that Russia and China have in gold, when you take their sovereign wealth funds, and for example, where they're stashing gold, and they've said that they're doing that. This is out in the news. We think they have many more tons than what they officially report at their central banks. And so we took that to mean, from Hugo Salinas Price's report, that Russia and China know that they have more gold, and that they know that the West has less gold, and that's given them power in the financial system to say, we're not standing for this petrodollar regime anymore. We're going to exercise our authority, in the financial markets. And so you see what's happening. You see now Basel III, you see the potential de-emphasization of the London and the gold market. You see Russia and China threatening to back their currencies with gold. What's happening is power in the gold markets is shifting west to east. It's very clear. And these are the signposts along the way that we see. And other countries are picking up on that, and they're trying to repatriate. I think all the central bankers of the world and all the finance heads of the world know what's going on. They're not going to tell the public and panic the public, but they know what's going on. And so now you're seeing those gold flows. You're seeing people say, ooh, I better get my gold back.
And it's interesting because we're also seeing a lot of inflation, and that spells bad news for the dollar, right? Now, I wanted to get your perspective on that, and kind of to wrap up, kind of on the Fed's decision, your perspective on this, because the Fed didn't really make any concrete decision yesterday. They just said, well, we might raise interest rates a bit sooner. So it seems like they are looking at the inflation, the skyrocketing inflation we're seeing, and saying, well, we might raise interest rates sooner, but they're still not making any concrete decision at the moment. So your perspective on that, and the inflation you expect in the near future, is it going to be transitory, as the Fed is saying?
So the Fed here, all they have to do is release a press report or have Powell say something, and it moves the market. The reason is, Elijah, because we're a financialized economy. It's not a value economy. It's not a product economy. It's an economy that lives on debt. And the lower the interest rate, the bigger the multiple you can get, the more money you can make in this market, the higher interest rate, the opposite. So what Powell says in terms of interest rate movements and what the Fed says that they're going to do with the central bank, that's the money spigot. And as you affect the money spigot, you affect how the economy reacts. So all they have to do is say, we might do something at some point in the future, and it's going to move the market. In fact, the markets will price in what they think the Fed is going to say prior to, and the Fed says something other than what the market thinks they're going to say, even though they don't actually do anything. They just, oh, we could do this. You'll see this market movement. And that's the power. The Fed has way too much power, but they have too much power because everybody's addicted to the money spigot or financialized. You cannot get out of it. So my thoughts on the Fed are, they have to be careful what they say, but they know that what they say is going to affect things, and they will say them at certain times to affect a certain outcome in the market. Now, I would say that the Fed's ability to do that itself is transitory, because yes, they're going to release a statement now, but the market's going to adjust, and then it's going to go back to business as usual. And so that effect is short term. If the Fed actually raises rates, just expect we'll have a stock market crash. Just expect we'll have companies start to complain about their debt load and not being able to service that debt. Expect the government auditors to say we can't pay this debt, it's unsustainable, interest rates are rising. Expect mortgage rates eventually to rise and other rates to rise, and the economy to slow down because people can afford less mortgages and cars and things like that. He can say whatever he wants. If he actually does it, that's what you have to watch out for. If they're stupid enough right now to raise rates, they just have stopped whatever economic recovery we may have had. And I don't think, depending on how they raise rates, I don't think it's going to stop inflation. When you look at what Paul Volcker did We had much less debt in the system. We had much more savings in the system. We had a much more stable economy. We do not have that now. We're at the other end of that spectrum. And so he cannot raise rates to 16, 17% like Volcker did. I mean, the American economy will completely and utterly collapse. I don't even think he can raise it 1%. Okay, so he can say what he wants, but watch what he does and watch if they actually do it. And that for a gold and silver investor was what really matters. To the debt addicted stock markets and the corporates, it matters what he says. To us, it matters what he does. And that's what we need to pay attention to.
That's a really good point. And that kind of gets back to focusing on the fundamentals of precious metals. Now, we have one last viewer's question from Nicholas. He's wanting to know, why are all commodities, it seems like, taking a heavy hit since the Fed's decision, but the stock market isn't? It's going down a bit, but we're not seeing that kind of dramatic decline like we are seeing in gold and silver and other commodities.
So my belief there is that the stock market would decline when you actually have an interest rate rise, because the way people value companies in the stock market, the models that they will use, and it's driven by software, by the way. So the software, yes, the software will read the press release, but if it's not an actual rate change, the software is not going to make a decision. The commodities complex is a little different because you have traders in there trading off of what they think the future will be. And if he's threatening to raise interest rates, that threatens to slow down the economy. That means there is a future expectation of commodity price fall. Although I think that's transitory. I think commodities prices will resume. So it's there are different aspects to that, but I think any effect either way is transitory until they actually do it. In the long term, it matters what they do, not what they say. What they say is short term, and that's perception management. If they actually raise rates, Katie, bar the door, because then you're going to see major problems in the economy, and you're going to see gold and silver physical demand continue to march up.
Will it be interesting to continue to report on this to see what precious metals are going to be doing in the future? This has been with Robert Kientz, as we've seen this incredible decrease in price over the last 2 days and continuing as we speak. Robert, if people would like to hear more about your work and find you, where can they go?
They can go to our website, goldsilverpros.com. They can find us on YouTube, Gold Silver Pros, Twitter, Gold Silver Pros, and on LinkedIn.
Perfect. And if our viewers would like to hear more of these interviews, keep up to date with everything we're doing, go to libertyandfinance.com. In the left-hand corner, sign up for our free newsletter. And if you'd like to acquire physical precious metals from us and Miles Franklin, call 1-888-81-LIBERTY. That's 1-888-81-LIBERTY. Robert, thank you so much for your time and all your insights today.
Can I give you a testimonial, Elijah?
Sure, definitely. Thank you so much.
I've used Miles Franklin quite a bit, and I have no affiliation with Miles Franklin other than I'm friends with the owner, but there's no sponsored content on my channel for Miles Franklin. But I want to say they're an excellent company. I've never had an issue with them at all. I trust Andy basically as a brother and as a friend. And if you're looking for a company to get your precious metals, I would highly recommend them.
Well, thank you so much, Robert. Yeah, and all the information is in the description of this video for that. And once again, thank you so much for your time, and God bless.
Thank you.